Good morning. Am I audible to everyone?
Yes, sir.
Okay, participant in this session, you can unmute yourself and say yes or no, or you can use the chat box. Okay. So, in today's session, we are dealing with the concept called depreciation. So, can anybody know in the last session what we discussed? Okay, in the last session, we have deliberated on the understanding financial statement for non-financial professionals. So where we have discussed the profit and loss account, that is income statement, balance sheets and cash flow statement. In this session, we are going to see the concept of depreciation. So let's see the learning objectives of the session. So, before we are going to understand the concept of depreciation, we have to understand the concept of convertism. It is very necessary to understand concept of convertism before understanding the depreciation and their provisions. So let's start with the session. So in this previous series, we have seen the concepts and convention of the accounting. So this is one of the concept, that is convertism. So basically, it states that the accountant should not anticipate the income and should provide for all possible losses. So means what? Basically this what we can say convertism in accounting, that concept suggests that when we face with the uncertainty, the accountant should consider error on the other side of the question. So not anticipating income means what? Can anybody tell me what do you understand the not anticipating income? Can anybody? No, okay. So basically, this means what we can say, the accountant or those who are recording the transactions should not record the income until it is certain, or we can say nearly certain, to be received. So, in other word, or we can say in simple word, accountant should only recognize revenue when it is earned or realized. Earn or realize means when it is actually coming into the business, or it will be receiving to the business. So suppose you have sold a goods on credit basis or cash basis. So it means you will receive the payment of that bill receipt. So this is, it will be received. So it is going to realize. If your goods will not be sent or sold, is there any income? No. But if you sold the goods, it means there should be a bill amount will be received to you immediately or in near future. Same way, if the patient is not admitted in the hospital or is not visited the clinic, can you consider the fee of that patient in your books of account? Can anybody tell me? Suppose a patient come to is not visited the clinic or is not booked the appointment for the visit. Can you consider that is your income? No. Yes, probably no. But if that patient come to the clinic or he booked the appointment by paying certain amount, then that will be considered as the revenue for your, because probably they will visit the clinic in coming days. So not anticipating income is very important. Second, we have to consider the provide for all possible losses. Means what? Basically, suppose what we can say, you have some hospital equipment, okay, and you feel that after certain period of time they will utilize and their life will be, the life of that equipment will be over or completed. So suppose within 1 year that equipment life is getting over, so you have to consider that particular expenses in your books of. Are you able to understand what I mean to say? You can say yes or no in the chat box, or you can unmute, and if you have any doubt you can raise it. Okay, so it means uh, this aspect emphasize the need to anticipate and account for potential losses or the expenses even if they haven't occurred yet. So this could involve setting aside reserves, reserve funds or reserve amount that this will be expenses in coming future. So for example, so light bill or rent expenses will be, we have to pay in coming period of time. So we have to make the provisions for the contingencies to ensure that financial statements or in the financial statement this should be reflected as a cautious estimation or contagious or provision for the company's financial health. So basically these concept deals with two aspects, that we should not consider the anticipated income and we have to make the provisions for the future possible losses or the expenses. Say, hence, these the concept of convertism helps ensure the financial statement provides a more prudent and reliable representation of company's financial health. Basically, in particular, in situation where there is an uncertainty, or we can say the risk is involved. So it is all about being cautious, and we should be a transparent in the reporting financial position. So which enhance the creditability, or we can say the reliability of the information provided to the stakeholders. I hope you understand this concept. Let's move further to understand more concept in the clear manner. So it is not a prudent to the count unrealized gain, but it is desirable to guard against possible losses. Like this, what we discussed in the previous slide, we should not anticipate the gains or the incomes, and also we should not count unrealized gains, because these gains are what we can say yet not received through proper transactions, such as increase in the value of the investment that has been sold. So the concept suggests that it is not prudent to count these unrealized gains as an income until they realize through actual sale. So guarding against all possible losses, it means we have to make certain provisions for the future expenses as well as the losses. So, or in simple word, what we can say, making or we can say the recognizing the expenses or the losses and making the contingent amount reserved for them. So, in short, what we can say, uh, concept of convertism in accounting emphasis prudence, caution, and the transparency in the financial reporting by avoiding overstating gains and actively safeguarding against potential losses, or we can say the expenses. So this concept, or we can say that this approach contribute to the reliability and creditability of the financial statement. It also enhancing, we can say, the trust of the investor, creditors, and the other stakeholders. So there are many alternative values of an asset. An accountant should choose the method which leads to lesser value. Okay. So the question arises, why we are giving initial deliberation on this concept? Because if we have to understand uh, the concept of depreciation and their what we can say the treatment in the financial book, we have to understand the concept of conversion. Because in accounting, when there are multiple accepted methods for evaluating an asset, so as you know, asset can be value for multiple, like we can calculate value of asset on book value method, market value method. So there are multiple methods. So it is necessary to use the proper methods, and we have to understand the alternative values of an accountant of an asset. So it is necessary to understand the concept of convertism. So this approach is help us to consistent with the broader idea of being cautious and convertism in the financial reporting, and it will help us to use the which method, like in coming session I will give you a simple example for understanding this concept. Like The stock, closing stock of the business is valued at book value as well as the market value. But at the time of reporting into financial books of account, it will be considered as the whichever is the less, that amount will be considered. Suppose the book value of the closing stock is 1 lakh rupees and market value is 1 lakh 20,000. So in that case, whatever the amount is lesser, that amount or that method value will be considered. So in this example, we have to consider the 1 lakh is the less amount for the book value. Suppose the market value is only 80,000 and book value is the 1 lakh. So in that case, the market value will be considered in the books of account at the time of record. So accountant should choose the method which leads to the lesser value. So understanding this concept now, okay, Manju Mathu, okay, Meenakshi, you did not understand. Can you unmute and elaborate what you are not understand? So it will help me to clear your doubt. Manju Mathu or Meenakshi Bharadwaj. So that will help me.
I have now understood. I had typed it a few minutes back.
Okay, okay, no problem. Okay, thank you. So let's move towards the next concept that I have already explained you. So closing stock. Second is the depreciation is, as you know, the charge every year through the cost of asset has not decreased. So we discuss depreciation in the coming slide. So you will understand the concept and use of this concept in relation with the reporting the depreciation. Now, can anybody, before we move towards the understanding the concept, can anybody light on the concept of depreciation? What you understand basically? Anyone can what you understand depreciation means? No? Okay. Basically, depreciation means a reduction in the value of asset or utility due to the passage of time, natural wear and tear, exhaustion of the subject matter. So, as I will tell you oh, that, yeah, okay, business point of view. Okay, first we can understand the concept in the simple word. Suppose you have purchased a car. Now, the value of the car remains same after the 1 year, and probably answer is the no. Answer is no, because the value will be going down. The reason behind is the utilization of that car. Okay, the value that will be decreased, that portion we call as a depreciation. Now it is in overall totality, not exactly, but for understanding purpose, you can consider it. So, like in a business, fixed asset. So, fixed asset are the asset which are which are generating revenues for long term. So asset like plant, building, machinery, furniture, loose tool, fixtures, etc. Okay. So that they use in their business for the purpose of production or providing services. So in hospital, you can take the example building, hospital equipment, and these assets are used regularly to provide the services to the patients. So after or a certain passage of time, the utilization happens, and the value of these hospital equipments is decreased. Now, the value of this hospital equipment, or we can say the portion of that value of the hospital equipment is utilizing for what? It is utilized for generating the revenue by providing services to the patients, and it must be charged during that particular year of time. Okay, so depreciation is nothing but the decrease in the asset value. So why it is decreasing the asset value? Because it may be caused by a number of other factors, such as we can say the usage, maybe the market condition might be there. Okay, why I'm saying market condition? Suppose you have taken one of the equipment, and after 2 years, the new equipment, new technological advanced equipment coming in the market. Now, whatever the equipment do you have, the value of that equipment automatically decreases. So, on that way, I have used the market condition, upcoming advanced product in that particular equipment. So, this will affect on the depreciation of the value. But that we can say, on the other hand, of the depreciation, it is also appreciation, which increase the value of the asset over a period of time. So, but in accounting, we only consider the decreasing value, and that will be used for the accounting information, and decreasing value for the particular life of that machinery or the equipment. Now, you saying that, for example, we have purchased a land. Land is a fixed asset for a 10 lakh rupees today. And after 2 years, the value of that land is appreciated. Value of land is appreciated. Can that appreciation value considered in the financial statement? The answer is no. Whatever the amount that we purchase, that is book value, will be mentioned in the books of account. Okay, so let's understand. I hope you understood the concept of the depreciation. So depreciation, the monetary value of an asset decrease over a time due to uses, wear and tear, or obsolescence. This decrease is measured as a depreciation. I hope you understood the concept. Yes or no? Okay, asset value is decreased day by day. Correct. How? As using that asset or only keeping the asset ideal, it is also decreasing. Okay, day by day reduction in the cost of the instrument. Okay, correct. So I hope you understood the concept. Let's understand the cause of depreciation. First is wear and tear. Can anybody Tell me, what do you understand by wear and tear? Look, we can interact to make this session interactive. So I also expect you can contribute, and your peers also learn from you. What you understand by wear and tear? Wear and tear means physical assets such as machinery, vehicle, equipment. After certain period of the regular use, which because of the usage, the value of that equipment will decrease. That is wear and tear. जैसे we use the car, and the usage of the car after 1 year, 2 year, the automatically the value of the car will be decreased. So wear and tear means uses of that particular equipment. Now absolute technology. So I have, I think, given the example in the market. So suppose you have purchased one equipment, let's you can take an example of our mobile phone. Now suppose you have purchased a 4G mobile phone today, and uh, after 1 year of time, after 1 year, you the 5G or 6G mobile coming into the market. Can you receive the same value of your smartphone or mobile phone, or we can say the computer laptop, after 1 year of time? The answer is no, because they or asset depreciate rapidly as newer model with improved features, technologies, or we can say capabilities are introduced in the market. So improved technological products come in the market, then that time whatever that machinery or asset you are using, the value of that asset will be depreciated or decreased. Okay. Next is causes expiry or obsolescence. So as you know, whenever we purchase any equipment or asset has a certain period of life. So suppose we have purchased a car. So life of car is how much year? The 15 year. Yeah, you saying there are, you might saying might be 20 years, 25 years. But officially on paper, the life of car or two-wheeler is for the 15 years. So on 15 years, we can use that asset for up to the 15 years. So after that, the value of that car will be become a zero or absolute after the period of their life. It means asset having a limited useful life. So you can take in the pharmaceutical example, patent, copyrights, licenses. So if we take example of patent, so if pharmaceutical company uh, done the R&D and come up with the new medicine, and they go for the patent and they earn the patent. So they got the patent for 5 years, 10 years, or a certain period of time. And after that, that patent will be open in the market. Okay, like this. Then next factor is the economic factor. Okay, just ambassador for, okay. Correct, Dheeraj. Due to the constant use, there is a loss of some functionality of. in the example car become slow and give less performance. The best example ambassador. Second best example Nokia phone. Another best example is the camera. Which camera can you give me the example? In 90s, which camera is famous? Kodak. Kodak camera. Now, can you see Kodak is no more in the market? Okay. Now, next is the economic factor. So, economic condition such as inflation, interest rates, then changes in the consumer spending pattern can impact the value of asset. Why I'm saying changes in the consumer spending pattern? Yes, sometimes consumers spend more on the uh, regular use items. If you see the value of the flats or constructions in a certain period of time is increases. So, like in Indian the tradition, we purchase more gold on Gudi Padwa, Akshay Tritiya, or Diwali occasion. So, certain occasions we purchase the gold. So, it will also affect the price on that particular product. So, spending pattern of the consumer is very important. Also, inflation, what inflation does? Inflation reduce the purchasing power of money. Okay. If inflation increases, our purchasing power of money over a period of time will be declined. So, economic factor we have to consider at the time of calculating depreciation. Then we can say natural factors. So, natural factors like environmental conditions, like you can consider the weather, natural disasters can be accelerate the depreciation of the value. So normally, if you see in the mm, if you take an example of the car, mostly the normal in Pune, what we can say that the car from the Mumbai or the coastal area should not buy for second time. Okay, should not be buy. Why? Because the rust is in the car. So that is might be a natural factor. Because of this says that the car from the coastal area should not buy. Second hand car from the coastal area should not buy. Then usage pattern should be considered. It is also affect on the depreciation. Okay, because assets that are subject to heavy usage, that will consider to the depreciation value. So these possible cause for the depreciation: wear and tear, absolute technology expiry, or completion of the life span of that equipment, economic factor, natural factor, usage pattern. Now, let's understand the objectives for providing depreciation. We have to ascertain with the true result of the operation. If we are not charging the depreciation on the asset, then we are not able to understand the true result of the business operation. Now, let me clear you that, and you also keep in your mind that depreciation is a non-cash expenses. What I am saying? you should note that depreciation is the non-cash expenses. Why it is a non-cash expenses? It is not actually paid by cash. Okay, आप भी अपने business में you are not paying that depreciation. You are only charging or you are mentioning depreciation in your books of account. So you should consider depreciation is a non-cash expenses. So we have to arrive with the true result of the business. We have to provide the depreciation. We have to understand the present true and fair value of that particular fixed asset. We have to provide depreciation. We have to accumulate the funds for the replacement of that asset. We have to provide. Suppose we have purchased one equipment, CT scan equipment. Suppose the price of that is 20 lakhs and lifespan is 10 years. Suppose after 10 years that equipment will be expired, or we can say life is completed. So we have to make the provision for that purchasing the new CT scan machine after 10 years. So we have to make the provision. So for making the provision, we have to charge the depreciation. So these are the objectives for providing the depreciation. Now next, factors in measurement. I just quickly go through it. Estimation of the exact amount of the depreciation is not easy. Generally, following factors should be considered in the calculation of the depreciation: the cost of asset, the useful life of the asset, the scrap value, that is salvage value at the time of the useful life of the asset. Now, the main aspect, we have to understand the methods of the depreciation value. Basically, there are four methods of the depreciation. First is the straight line. Second is the written down. It is also called as a reducing balance method. Third is the machine hour method. And fourth is the production unit method. But in general, these two methods are used or considered widely in the businesses. Look, this probably in the manufacturing sector, this will be considered, but these two methods are widely used in the accounting. So let's understand one by one. So first is straight line method. As a name suggests, straight line. So depreciation is on calculated on the straight line method. So it is one of the most commonly used method, or we can say the technique for calculating the depreciation value on tangible assets over a useful life. So under the straight line method, depreciation expenses is allocated evenly over a useful life of an asset. So this means the same amount of depreciation is recorded in each accounting period regardless the actual usage of assets or productivity. We will understand with the help of example also, so you will be able to understand concept more. But it is very important to understand the equal amount of is written off every year. So suppose the value, life of the asset is 10 year, amount is the value of asset is 1 lakh. So every year 10,000 depreciation will be considered. That is a straight line. Okay. Now let's see the example. Now here you can see the formula. The formula for calculating the depreciation using straight lines, that is depreciation is equal to cost of asset minus salvage value divided by the useful life. Now cost of asset means what? The initial investment, or we can say the initial cost of acquiring asset, including any expenses incurred for that particular asset, like installing that machinery or delivery cost that we can consider. Salvage value, salvage means the scrap value. At the end of the life, the value of that asset, scrap value of that asset will be called as the salvage value. So, estimated residual value of asset at the end of its useful life. So, this amount of asset is expected to be worth after the depreciation. The useful life expected period over the asset will be considered as a useful life. So the formula for calculating depreciation value or expenses is cost of asset minus salvage value, that is a scrap value at the end of the life, divided by the useful life of the asset. So let's understand by the simple example. So I request you can just write down this in your notebook. The cost of machinery is 45,000. The installation charges is 5,000. The useful life of asset is 10 year, and we have to calculate the depreciation. So I expect you can just calculate the depreciation. We'll give you 2 minutes. You can put it into the chat box, or you can unmute and say. Please let me know once you completed. Okay, I will showcase you the formula so you can understand. Okay, cost of asset minus salvage value divided by useful life of asset. Have you completed? Please let me know. Yes, anyone has completed? Yes or no? The cost of machinery is 25,000. Installation charges is 5,000. Useful life of asset is 10 years. So it means 45,000 plus 5,000 divided by T. So it means how much it will arrive? It will arrive 5k. It will arrive 5k. I can showcase my answer. So depreciation will be calculated as a 5,000. I hope you understood. Yes or no? Please let me know your response. Otherwise, I could not able to understand whether you understood the concept or not. So I suppose you understood that concept. Let's move towards the next concept, reducing balance method, or we can say return down value method. So it is also called as a return down value method. Okay. So in this technique, or we can say depreciation method, is also commonly used in the accounting to allocate the cost of an asset over its useful life. So it is also called as a gradually reduction in the book value of the asset. So unlike straight line method, which allocates the equal portion of amount or equal amount of the portion of depreciation expenses in each year, the return down value method depreciates asset at fixed percentage of their book value, leading to the gradual reduction in the assets carrying certain portion or certain percentage in a year. So, in this method, we have to understand there should be a fixed percentage will be considered. Fixed percentage will be considered. So let's understand so you can clear this concept. So return down value method formula is, you can see on the screen, return down value is equal to the acquisition cost minus depreciation. So depreciation, return down value into the depreciation rate. So let's understand with the example. So before we understand the example, we just see two main advantage of this method. The total charge to the total revenue is uniform when the depreciation is high. So it means the certain percentage will be charged every year on the return down value of that asset or reducing balance of that asset. So this will helpful when the depreciation will be high in rate. In this method, the repairs also negligible, and as the repairs increases the burden of depreciation and gets lesser and lesser value of. So these are two main advantage. Now, when we calculate the first year value for depreciation is the acquisition cost or initial cost for the investment into depreciation, and after the first year, second year, third year, fourth year, the return down value into depreciation rate. Let's is any doubt? Is I'm going fast? Let me know. If you are not understood, please let me know. So let's understand with the help of example. Now, cost of machinery is 50,000. The scrap value of machine is 5,000. The useful life of asset is 10,000. The depreciation rate is 15% per annum. Now, we have to calculate the depreciation as per the reducing balance method or return down value method for first 2 years. You can just note down this example. Again, I am repeating. Cost of machinery is 5,000. Scrap value 5,000. The life of asset is 10 year. Depreciation rate is 15%. And we have to calculate depreciation amount for first 2 years by using this method. Now again I am showing you the formula. So first year formula is acquisition value, that is initial cost of the asset into depreciation. Second year return down value of that asset into depreciation rate. Now first year you can see on the screen initial cost will be 50,000 into 15%. So first year depreciation will be 7,500. Okay. Now when we go for the second year, we have to minus this depreciation from the initial value. So the after minusing this depreciation amount, this value come, that value we call as a reducing balance or return down value. So second year again we are calculating depreciation fixed percentage, that is 15% on the return down value. So second year the depreciation value will be lesser than the previous year. Now if we calculate for the third year, then in that case we have to minus this figure from this. We have to minus, then we will get the exact return down value. It means near about 35,125, I hope. 36, no, 36,125. So third year we have to calculate 15% on this at the time of calculating depreciation value. Okay, so first year, no, second year 6,500, no, 15% we have to calculate. So 15% how much? 45,500, so 6,375. Okay. Now is any doubt? No. Now we will understand machine hour method. Now before understanding machine hour method, we just quickly recap the concept of the straight line method and the written down method. In the straight line method, the equal amount of portion will be charged as a depreciation over a lifespan of that particular asset. In the return down value or the return reducing balance method, certain percentage will be calculated on the value. Certain percentage will be calculated as a depreciation on the value of that asset. Initial year, it is a cost of acquisition or the acquisition cost, and after that the percentage will be charged on the reducing balance or written down value of that asset. Now, next, machine hour method. I will quickly explain this method. Machine hour method is a depreciation techniques that allocates the cost of an asset over useful life based on the number of hours that asset is expected to operate. This basically method is commonly used for these machineries, equipment that are primarily used in the manufacturing, or we can say the production process. Basically, we can say that it is a usage based depreciation. What I'm saying? Usage based. How much that asset is used. On that basis, we calculate the depreciation under this method that we call machine hour method. Okay, simple usage based depreciation. So let's understand the example with the, so cost of machine is 5 lakhs. Estimated working hours is 40,000. Scrap value is 1 lakh. The pattern of distribution of effective working hours is first 2 years 5 hours, 3 to 5 years 7,000 per year, 3,000, and compute depreciation. Now first year, why I am saying, look, how much machine is used? 5,000 hours into cost of machine minus scrap value. The cost of machine is 5 lakh minus scrap value is 10,000 into total number of estimated hours. कितना आवर तक चलेगी? 40,000. So the first 2 years the depreciation value is 6,250. Again I am repeating, this is hours that machine is work or used for the first 2 years into cost of machine minus the scrap value divided the estimated working hours in lifespan. So vice versa for 3 to 5 years, 6 to 8 years, the value will be derived. So you can correlate that if the usage will be increased, like here you can say 5,000 hours of usage, and here usage is increased to 7,000 hours, you can say the value of depreciation is increased. Usage decreases, the value also decreases, so depreciation is also decreases. I hope you understood that. Now second, production unit method. Now it is also known as a unit of production method, and is a depreciation technique that we can say allocate the cost of an asset over a useful life based on the number of units that asset produces over the process. So if you remember in machine hour, number of hours that machine were used, on that basis we calculate. In production, number of unit that produces, on that basis we calculate the depreciation. So this method is commonly used for the asset such as machinery, equipment, vehicles that are primarily used in the production or manufacturing process. So in machine hour, it is hourly based depreciation, and in production based, it is a unit based depreciation. So how much of the unit that produced by that particular machine, on that basis we calculate the depreciation. So how it is different? Instead of depreciating an asset based on the time or book value, the production unit method allocates depreciation based on the actual output or usage of asset, that is measured in terms of how much units are produced. So these metrics will be considered. So depreciation expenses for that particular, or we can the specific period, is calculated by multiplying the depreciation rate for number of units produced or processed during that period of exam. Sorry, uh, period of lifetime of that machine. So how we calculate depreciable production during the period into cost minus salvage value into estimated total production. So let's understand with the help of example. The cost of machine is 3 lakh 3000, estimated production is 4000, salvage value is 2000. So pattern of distribution of production is first year 2000 units, second year 1500, third year 500 units. Okay. Again, I am showcasing the formula. Depreciable production, that is number of units that is produced into cost minus salvage value divided by estimated total production. And this is the example. So first year 2000 into 3000, that is the cost, 2000 is the scrap value, and estimated production is 4000 units. So like machine hour, you can see the if the number of unit produced by machinery is decreases, the depreciation charge also decreases. Are you able to understand? Yes or no? Okay. I hope you understood these things. Now let's move recap this four method. First is the straight line method, where equal portion of amount will be considered as a depreciation for over a period of lifetime of that asset. Second, return down value, fixed percentage will be charged on the value of asset. That amount will be considered as a depreciation. Third, machine hour. So number of hours will be considered for calculating depreciation on asset. Production unit method. Number of unit produced by the machinery will be considered for calculating the depreciation. Now let's understand these two four provisions quickly. Okay, before that I will comments. No, okay. So provision is a liability. which cannot be measured with the substantial degree of the accuracy. Liability is a present obligation of the enterprises arising from the past event, the settlement of which is expected to the result in the outflow of the resources. So depreciation is the provision. Please note down, depreciation is the provision and it is a non-cash expenses. We are not actually paying the cash. Hence, provision is the liability. Where the liabilities are unknown, the amount is cannot be precisely determined, and we estimate the liability and provide for it. Here, the principle of convertism supports the making the provision for the probable liabilities. Okay, so provision it is considered as a liability. Depreciation is the provision on that asset. Okay, any doubt up to this? No. So example, let's say product service warranty cost is a provision. Bad debt it's a provision. Bad debt means suppose we have sold the goods on a credit basis to five customers. 10, 10, 10,000, 50,000. We have sold the goods on credit basis. And we feel that one of the customer will not pay our dues. So we make a provision of the 10,000. That is a provision. That is a bad debt that may or may not be recovered in the future time. But we here right now we feel that that amount will not be recovered. That is bad debt. Changes in the foreign exchange rate in case of international transaction. That is a we make the provision for that. So these are the examples of the provision. So any doubt till now? So we conclude the session. I think we conclude session on the time. We understood the concept of the convertism, where we will not anticipate the income before it's realized. We have to make the provisions for the possible losses or the expenses. Then we understood the concept of the depreciation. Depreciation is the non-cash expenses. There are four methods. Two methods are commonly used, straight line and written down. Machine hour and production unit based method. It is not uncommonly used and mostly applicable to the more manufacturing or production industries, but mostly in also manufacturing and production industry, they use written down or the straight line methods. Rarely these machine hour or we can say production unit methods are used. So now the platform is open for the discussion. You can unmute yourself and you can ask your queries.
Can you explain that part of provision once again?
Yeah, pardon?
Provision and liability.
Provision and liability. Look, whatever provision in your life also you make the provision. Yes or no? Provision is the liability.
Yes.
Suppose you are taking the health insurance or you are taking the insurance, yeah, accidental insurance. Why you are taking? You are making the provisions for uncertain or a uncertainty in future. So it is a liability. I hope I understand. I clear your doubt.
My doubt is what is the difference between provision and liability?
Mm, Provision and liability, the difference. Look, liability means your obligation. Provision means you are making certain uh, provisions or certain things to tackle future uncertainties. Suppose after 10 years your child will go for the higher education. So you are making provision for every year 50,000 for your child for pursuing the higher education. So that is the provision for future liabilities. Liability is the obligation. So all provisions are the liabilities. Now clear?
Yes, yes, thank you.
Any doubt about today's session? Dheeraj, your question is indemnity insurance. Can you elaborate that concept? So it is in case of hospital we take indemnity. No, indemnity insurance. No. Make provision for un, unwanted. Okay. I did not understand what we want to say. Yes, indemnity. We take the insurance. Indemnity insurance that we call indemnity. Can anyone, any other, or would you like to say anything? So I hope. So shall we stop for this session?
Yes, sir.
Okay. So I hope you understood the concept of the depreciation, concept of the convertism, because convertism concept we have to understand when we have to understand the implication of the depreciation in the financial state. We understood the four methods: straight line, written down, machine hour rate, and the production unit. So that's for the day. Thank you very much. If you have any doubt, you can share your doubt with your coordinator, and your coordinator will approach me, and I will resolve your queries. Thank you very much.
Thank you, sir.
Thank
Students
you.
are requested to fill in feedback form.